It's a Tuesday morning in Phoenix, and a woman is sitting in a car that won't start. The shop quotes her $340. Alternator. She has $91 in checking and 6 days until payday.
So she finds a lender online, fills out a form, and by lunchtime, $350 is in her account. The fee is $52.50. She looks at that number and decides it's survivable. She's right. That part she can handle. 14 days later, she opens the app to pay it back. Her balance is $12. Not because she overspent. Because at 5 minutes past midnight that morning, something had already reached in. To understand what happened to her, you have to look at the loan from the other side of the table. Not as a borrower, as a business.
The principal is $350. The fee is $15 for every 100 borrowed over 14 days. That's $52.50 in revenue. Now the other column. Most online lenders don't find customers, they buy them. A single qualified applicant purchased from a lead aggregator costs somewhere between $50 and $150. Add processing, servicing, and money set aside for the loans that never come back at all. Put those side by side, and something strange appears.
The borrower who takes $350 repays $402.50 on day 14 and never comes back. That borrower is roughly break even, sometimes a small loss. The business doesn't start working until the same $350 gets extended 4 times, 6, 10.
Each extension collects another $52.50, while the principal sits exactly where it started. Which means the profitable customer and the customer who pays you back are 2 different people. Sit with that, because everything else follows from it. The Consumer Financial Protection Bureau's own data tracks that incentive almost exactly. More than 80% of payday loans are rolled over or followed by another loan within 2 weeks. 3/4 of all fee revenue comes from borrowers taking out 10 or more loans a year.
Those aren't failures of the product. They are the product. The loan is just how you enroll. So if the money is in the extensions, who gets selected for one? Type "need cash today" into a search bar, and the site you land on is often not a lender at all. It's a lead generator.
You enter your income, your employer, your pay frequency, your bank details. You press submit. And before the page reloads, your application has been pinged out to dozens of subprime lenders who bid on you in a live auction. The industry has a name for that structure, a ping tree.
The winning bid can run past $150 for one applicant. So what are they bidding on? Not a credit score. A traditional score mostly just says high risk, which the lender already assumed. These models read cash flow instead, looking for a particular shape. Steady direct deposits.
Proof there's something to debit, arriving on a schedule. Low ending daily balances. Proof that after repayment there won't be enough left to finish the week. Read those together and you can see the profile being selected for. Employed enough to collect from, stretched enough to come back.
In most lending, financial fragility lowers your value as a customer. Here, it raises your price. So the loan is issued. Now comes the part that decides everything. Approval usually requires authorizing an ACH debit, permission to pull the repayment directly out of your checking account.
That permission is the collateral. To use it well, the lender needs to know one thing precisely: when your money arrives. Account connection tools make that easy. Verify a bank account, and the platform can read months of transaction history. Every deposit, every amount, every timestamp.
A pattern falls out almost immediately. Deposits land Friday, just after midnight, roughly the same figure each time. So the debit gets queued for 5 minutes past midnight, Friday. Not Friday afternoon once rent has gone out. 5 minutes after the money lands, ahead of everything else that was waiting on it. Watch what that does to a month. The deposit hits and the balance jumps. Minutes later, the repayment sweeps out. What's left has to cover rent, gas, groceries, the phone bill. It very nearly does, but not quite. By day 13, the balance is flirting with 0. And that is exactly when the notification arrives. Need a little extra before the weekend? Reopen your credit line. One tap. It feels like coincidence. It isn't. The offer is timed to the bottom of the trough, because the bottom of the trough is where the answer is yes.
The woman in Phoenix didn't fail a budgeting test. She was repaid from first, by design.
Then there's the screen itself. Open the app near your due date, and the interface has already made a suggestion. The bright button, centered, sometimes pre-selected, says something like Extend, Fee Only. One tap, and the due date moves 2 weeks.
The option to pay the principal down and be finished is usually somewhere else, a submenu, 2 or 3 confirmation screens, sometimes a phone call during business hours. Neither path is hidden exactly. One is just a slide, and the other is a staircase.
And these layouts get tested against each other constantly, which means the difference in friction isn't an oversight, it's a measured result. And if you simply don't have the money on the day, there's machinery for that too. When a debit fails, the lender generally tries again.
CFPB research found that when the first automated attempt bounces, about 3/4 of the follow-ups bounce as well, and each one can trigger a fee from your own bank. Across a single loan sequence, borrowers accumulated roughly $185 in overdraft and returned item charges.
That money doesn't go to the lender. It goes to a bank that lent you nothing. The most extreme version of this ended up in federal court. In the case against Scott Tucker's online lending network, the fine print didn't set up a loan that could be repaid in a single payment.
It renewed automatically every 2 weeks, taking a $90 fee each time and applying nothing to the principal. A $300 loan could end up costing more than $975. That's the outlier, but it's an outlier of the same design. None of this went unnoticed.
In 2017, federal regulators finalized a rule with a straightforward requirement at its center. Before issuing one of these loans, a lender had to check whether the borrower could repay it without reborrowing. Ability to repay, the same question a mortgage lender must ask.
In 2020, that requirement was revoked. What survived was narrower, a limit on payment retries. After 2 consecutive failed attempts to debit your account, a lender generally can't keep trying without fresh authorization. Worth knowing, it's one of the few guardrails still standing.
Meanwhile, the model migrated into advanced apps funded by voluntary tips and expedited transfer fees, and into partnerships with chartered banks designed to sit outside state interest caps. The industry's argument deserves a fair hearing, because part of it is true.
Millions of people are locked out of mainstream credit. The demand is real, and default rates here genuinely are high. Lenders describe extensions as flexibility for people who need more time.
That works right up until you look at where the revenue concentrates, 3/4 of all fees coming from the people borrowing 10 or more times a year. Here's the useful part. If the mechanism is timing, then timing is also the lever. First, that ACH authorization can be revoked.
In writing to the lender, paired with a stop payment order at your bank filed at least 3 business days before the scheduled debit. This does not erase the debt. It separates the debt from automatic access to your account. So you decide what your paycheck covers first. Keep copies. Second,
If a lender keeps hammering your account after repeated failed attempts, that's exactly what the retry limit prohibits, and complaints to federal and state regulators are free to file. Third, many states require lenders to offer an extended payment plan, installments, without new fees stacking on top.
the catch is you usually have to ask before you default. Asking early is the whole game. Fourth, there's help that isn't an advertisement. Accredited nonprofit credit counseling agencies will walk through your options at little or no cost, and your state's regulator supervises licensed lenders. Neither is trying to sell you a second loan. And then the structural one, which is slower but ends the cycle for good. The sweep works because there is nothing behind the account. Every part of this system depends on the moment your balance hits zero, and something still has to be paid. Any cushion at all changes the order in which those dominoes fall. That's not a fast fix, but it's the only version of this where the timing works for you instead of against you. Nothing about that Tuesday in Phoenix was unusual. Steady job, thin balance.
A $340 alternator on a day she didn't choose. What turned a 2-week problem into a 5-month one wasn't her arithmetic. It was that the product she reached for had been engineered around the exact moment her account hit bottom. Knowing that doesn't make the money appear.
But it moves you out of the passenger seat. And in a system built on timing, understanding the clock is most of the fight. If this helped make sense of something designed not to make sense, consider subscribing. We untangle one debt trap a week here, calmly, with the receipts.
And if you're in one of these loans right now, nonprofit credit counseling is free or close to it, and your state regulator and the federal complaint process exist for exactly this. It isn't a character flaw, it's a business model.